You've heard the old advice, buy low, sell high. But looking at the stock market today, it is incredibly easy to get fooled. A stock trading at $5 isn't automatically cheap, and a stock costing $500 isn't automatically expensive. To navigate this, you need a system. By the end of this video, you will know 3 distinct step-by-step methods to calculate exactly what a company is actually worth. To get started, you'll want a free financial data tool, like Ticker, and a stable test subject. For our walkthrough, we're going to use Coca-Cola. The moment you stop guessing based on the share price and start calculating the underlying value, you stop gambling and start investing. Step 1 is applying a crucial filter. Before we run any numbers, we have to make sure our target business has a long, proven track record of stability. We are actively looking for an absence of rapid change. Warren Buffett intentionally avoids high-flying tech stocks for this exact reason. If an industry is changing rapidly, it is nearly impossible to predict how much cash that business will generate 10 years out. This chart shows the difference. Notice the wild, jagged swings of a trendy software firm compared to the slow, boring growth of consumer staples. People buy carbonated drinks today the exact same way they did decades ago. If the business model itself isn't predictable, any mathematical valuation you apply to it will give you a worthless result. Step 2 is relative valuation. We start with the price to earnings, or PE ratio. This infographic shows a college degree evaluation. If you pay $200,000 for an education that boosts your salary by $100,000 a year, you have a payback period of 2 years. A stock's PE ratio tells you exactly how many years it will take for the company to earn back its current share price. This diagram illustrates 2 ways to measure that timeline: past earnings, or the trailing PE, and analyst expectations, the forward PE. Because you can't pay bills with past performance, we rely on the forward PE, dividing the current stock price by next year's estimated earnings. To see if our stock is a good deal, we check its current forward PE against its own 10-year history. Then we average out its competitors, companies like PepsiCo, Dr. Pepper, and Monster, to see what investors usually pay for this specific industry. Scanning the peer group often highlights a secondary target. For instance, a smaller Scottish beverage maker called AG Barr currently trades at a lower multiple than Coca-Cola, offering a higher potential upside if it eventually reaches the industry average. But relying purely on peer comparison is dangerous. Imagine your friend buys a $100,000 dog, and when you ask how he afforded it, he says he sold his $200,000 cat. Relative valuation only tells you what is comparatively cheaper. If the entire industry is currently overpriced, buying the cheapest company in the group still guarantees a bad return. To find the real truth, we need an absolute method. Step 3 is the discounted cash flow, or DCF model.
This answers the 3 questions Warren Buffett asks of any investment. How much cash are you going to get? When are you going to get it? And how certain are you? First, we find the free cash flow. Open the company's cash flow statement, locate the operating cash flow, and subtract the capital expenditures. This reveals the cold, hard cash the business actually produced after paying to maintain its current operations. This bar chart projects that free cash flow 10 years into the future. Instead of plugging in optimistic double-digit estimates, we apply a conservative historical growth rate. For Coca-Cola, we use roughly 4% per year. Next, we apply the discount rate. Because money today is worth more than money tomorrow, you could always just put it in a bank and earn guaranteed interest. We have to reduce the value of those future cash flows. A practical way to set your discount rate is to take the current 10-year government treasury yield and add 3%. Right now, that gives us a required return of around 7.5%. Finally, we add an exit multiple to cover all the years beyond our 10-year projection, called the terminal value, and sum them all together. The resulting figure is the company's intrinsic value. The DCF model forces you to lay out your assumptions. It takes subjective expectations about future growth and translates them into a single concrete dollar amount for today. This diagram outlines a third valuation option to speed up the process. You can use a forecasting tool to blend historical financials with professional analyst estimates, plugging in sales, operating margins, and tax rates to project an expected annual return. In our test case with AG Barr,
the tool outputs a projected annual return of 9.3%. You then compare this against your required discount rate of 7.5%. The gap between your required return and the projected return is your margin of safety. This buffer exists entirely to protect your capital if your initial growth estimates end up being too optimistic. For a highly predictable business in a stable industry, a smaller margin of safety, around 20%, is often perfectly acceptable. A margin of safety acknowledges that valuation is an imprecise art. It bridges the gap between our exact mathematical models and the messy reality of the future market. This triangulation chart summarizes our three distinct data points: the relative comparison of the PE ratio, the absolute intrinsic value from our DCF model, and the projected annual return from our forecasting tool. As Charlie Munger noted, calculating value isn't a mechanical process where you punch a button and get rich. It requires cross-referencing multiple models.
When you run these three checks and all of them align, showing the stock trading below its historical average, below its intrinsic value, and offering a sufficient margin of safety, you have successfully located a genuinely cheap stock. Pick your favorite predictable company, pull up its cash flow statement, locate its forward PE, and run these three calculations to see exactly what you are paying for.